Hello, everybody. Welcome to Best of Us Investors. My name is Jacob Braun, and today we're going to be talking about a really good defensive recession play for this upcoming very rocky economy. That company is Johnson & Johnson. Okay. So I said defensive recession play. What do I mean by that? What I mean by that is this is a very safe play that is going to probably outperform the market when the market does bad. The reason for this is because Johnson & Johnson is a healthcare stock. So it's in a very non-cyclical business. What's a cyclical business versus a non-cyclical business? So cyclical business is a business that goes through cycles with profit. For example, a business like Disney is going to experience booms and busts in how many people come there based on how well the economy is doing. When the economy is doing well, lots of people are going to go to Disney World. They're going to make a lot of money. When the economy is doing bad, less and less people are going to travel, and so therefore less people are going to go to Disney World, and the company won't do as well. So it goes through a cycle. Now, Johnson & Johnson is in healthcare. In healthcare, you have a fixed cost. You want to live regardless of the economy. And so you're going to cut off other spendings, some excess or fun spending per se, in things like Disney or Netflix, or less than the amount you spend at grocery stores. And so it's a non-cyclical business for that reason. Additionally, Johnson & Johnson is a very big company. It's a $440 billion market cap company, so it's going to be very stable, and stability is what you want in rocky times. Additionally, the company is a dividend aristocrat that pays a 2.7% dividend. So if you put $100 into the company, you'll get $2.7 back per year. And the company has increased or raised that dividend for the past over 25 years. So that's a great track record. So again, kind of highlighting this, pharmaceutical companies and healthcare companies in general are really good companies in recessions, because you have the cost of your drugs, and you're going to pay those regardless, because it's a non-cyclical business. Johnson & Johnson is a very big company, so that makes it very sturdy. And second, Johnson & Johnson has a very good dividend record. Now, let's dive into the company a little bit more. One reason I like Johnson & Johnson for the general investor over other pharmaceutical companies, your Pfizer's, your Eli Lilly's, Biogen, other big pharmaceutical companies, is because Johnson & Johnson isn't just a pharmaceutical company. And they also are in medical technology and consumer health. And I really like this as an investor because it creates a little diversification. Pharmaceutical business is very profitable, but it is always cycling because drugs can only be have a patent for a certain amount of years. Typically is around about 10 years. And after that time period, people can create a generic drug for next to nothing, and the pharmaceutical company basically doesn't make any more profit off that drug. So for that reason, they have to spend a ton of money on R&D to keep finding new drugs, or spend a lot of money on acquisitions. The point is, they're kind of owned by their pipeline. They always have to have something new coming up, and this is very costly. It creates some uncertainty in the future, so people don't pay a big premium for pharmaceutical companies because their earnings are variable, even though they're very stable when they're earning that money. So Johnson & Johnson, you have this big earning potential from the pharmaceutical business, but they also have another about 60% of the company that does other things, medical technology devices and consumer health, which kind of just diversifies the income away, which makes it an even more stable and safe play for a rocky economy. So last quarter, so that'd be Q2 is the last quarter we have data for. Johnson & Johnson had $24 billion in sales, and that resulted in $7 billion in earnings, which resulted it to $2.59 per share. So how those shares were, those earnings were split, or revenue was split between the three divisions. 3.8 went to consumer health, 13.3 went to pharmaceutical, and 6.9 went to med tech. Those numbers were all in the billions. And like I said, the company currently pays out a 2.7% dividend. So you have a diversified company that pays out a great dividend. Okay, dive in a little bit deeper, the 4 reasons. The number one, again, healthcare sector. I really like the pharmaceutical sector, the healthcare sector, um, in these uncertain times, because these costs for drugs and for healthcare products is going to be fixed. If you're a consumer, you're going to cut many other things before that. Because of that, you're going to have very consistent earnings. In times when the economy is booming, these companies typically aren't as good of investments, because high growth companies like cyclical companies, Netflix, Apple, those are going to perform way more and generate way bigger gains during those times. But those same companies will also perform way worse than the market, which is an average of all the companies, right? It's going to perform worse than the market in these bad times. So you want to invest in those safe, boring, slow growth companies in bad market times, because those are going to perform less worse per se than the average of the market. And in those exciting bull market runs, you want to invest in high growth companies, because those are going to give you the most gains. Again, that rule kind of varies depending on your personal situation, but that's kind of like a general rule many investors follow. A second, like I said, I keep harping on this. The diversification of Johnson & Johnson is incredible. You're going to get, it's probably the biggest pharmaceutical / healthcare company with this amount of diversification. Is about evenly a third-ish roughly of these 3 divisions, which all have very different markets, with tons of products in each market. Just if one thing goes bad or you have poor leadership in one division, the others are going to help make up for that. Again, that diversification that limits your growth, one, because the company's so big already, but two, they just don't have as much places to go. But again, we're not looking for growth right now. We're looking for stability, because we're just trying not to fall in a bad economy. Another thing, a solid dividend. So there's only 65 dividend aristocrats. A dividend aristocrat must raise or maintain their dividend for 25 plus years. This is a massive accomplishment. So the current yield of Johnson & Johnson is 2.7%. The S&P 500, so the average yield of the 500 companies, is about a 1.7% yield. So this is above an average yield. Again, a lot of companies, especially those high growth companies, retain their earnings and don't pay a dividend. So that kind of skews it. So if the market falls, though, your dividend yield actually be even more. So if the market falls, let's say, extreme example, you're at $100, is a 2.7% yield, falls 50% down to $50 for a share, that yield would double. So if you can wait or dollar cost average in, you can get an even better yield on those shares. And when the price rises in a better economy, if you decide to hold it, that you paid a great premium, because then the yield will go down. When the price rises, the yield percent goes down. So a great dividend record. And the other thing that dividend record shows is years of great leadership. It takes great leadership, great profitability to pay out that dividend, increase it year over year over year. And so that just shows, Johnson & Johnson is in a very good financial place, has been for many years. And that's what we want in a bad economy. We want a company that's going to be stable, that's going to be in a very good financial place. And Johnson & Johnson's had that for years upon years. Historical returns, Johnson & Johnson over the past 10 years has grown 140%. So if you average that by 10, that's about 14% per year. And then we also have a 2.5% dividend. So, these are below market returns, because the market returned 18% roughly during that time, but it's still very solid returns. So you can get good returns. So overall, though, why I like Johnson & Johnson, it's a very safe, I keep saying this word, safe, stable, big company in uncertain times. We cling to these companies that are going to be stable when the market falls, because these higher growth, more fun, flashy companies are going to fall far worse than bigger, stable names. You're going to miss out on the massive growth that you're going to see in other companies in those bull markets. But in the times of uncertainty, I want to cling to big companies and non-cyclical markets that have very good financial records and leadership, such as Johnson and Johnson. For that reason, I really like Johnson and Johnson right now, and I think it is a very good investment. Again, please do your own research. This is not financial advice. You should look into it yourself, but I think personally, I really like Johnson and Johnson. With that, thank you so much for watching this video. Make sure to like and subscribe. And I'm going to be new here. I'm going to be doing a weekly video. I've been on before. So comment down below or reach out to my Twitter at RealJacobBraun if you have any video topics you want me to cover. I cover heavily a lot of biotech companies, and I cover a lot of more higher growth, flashy, picks like that. But if you guys want me to cover more of these kind of safer, stable, really staple picks of a portfolio, let me know. If you want me to cover more of these high growth companies, let me know. I'm here to provide you guys with the content that you guys want to see. Again, thank you so much for watching.